Yeah, you are live. Go.
Hi to all our viewers who've tuned into this very special edition. This is Money Control Markets Weekly, your destination for everything that has been going on in the markets in the last 24 hours. We get you a detailed breakdown of what has happened in the markets. We have guests joining us every week to give us updates and tell you some important cues as well to watch out for as you get ready for a brand new trading week. Today on the show, joining us is Mr. Sunil Subramaniam from Sundaram Mutual Fund. Mr. Subramaniam, always a pleasure chatting with you and welcome aboard.
Hi, thank you, and good evening to all the viewers.
So it's Akshay Tritiya today, a very auspicious day that we're starting off our brand new series as well. What have you been doing? Of course, being a fellow South Indian, I'm sure your family, you also must be invested quite heavily in gold in one way or the other. What have you done and where have you invested?
See, I would not put gold and investment in the same statement. Okay, yes, we do buy a lot of gold, but it's not from an investing outlook. It's more an emotional, psychological thing. That every family has some gold. So token purchase on Akshaya Tritiya is all that we do. So in fact, it's absolutely not the right time to put money in gold if you look at the global cues. So to that extent, gold is an allocation, but not necessarily from a wealth creation perspective.
All right. Well, it's an emotional buy then for you guys. But let's talk markets, Mr. Subramaniam. Especially if we look at today, markets have been quite choppy, not just today, but overall since budget, we've seen it very range bound, 15,500 to 14,000 for the Nifty. That's precisely been essentially the range for the benchmark index. Tell us, what is your view? I mean, when do we finally, break out of this range and actually headed somewhere meaningfully?
See, I'll tell you what happened was the budget was very positive for the markets because of the infra orientation, right? That Nirmala ji brought to the table. And initial FII outlook towards the budget was very positive. We got flows in. But then, the second wave coming up, uh, I think caused a dampener. And I think this time, what the second wave, how differentiated from the first wave, is that one, in the first wave, the government placed health ahead of the economy. This time, the government is
Hmm.
placing the economy at par with health. So, when you look at it from that perspective, right, the first time since the health was taken care and India was in fact ahead in terms of vaccination and controlling the pandemic and lockdown and everything, foreigners had
Hmm.
put in a lot of money into our markets. But this time around, despite the fact the government is giving more importance to the economy, the fact is
Hmm.
that the health related parameters from a visibility perspective, ventilator shortage, vaccine shortage, remdesivir shortage, I think it's creating a kind of an image of India outside to making foreigners a bit cautious. Saying, is the fact that the economy is being taken care in the short run, but is the health impact going to significantly affect the growth path? Already you're seeing that the this year's growth has been revised down by as much as 100 to 200 basis points by some analysts.
True.
So I think that what is happening is that foreigners are taking a little breath. They're taking a pause from India, and luckily the volatility has been much less than would have otherwise been expected because domestic mutual funds and insurance companies have stepped in and started buying. So that's why it's range bound because of the situation as it develops. And to answer the question that you asked here to say how long will this be? Well, the government is out there saying a third wave is certain. So I think that if you look at it, the way we manage the health part of it over the next 3 to 4 months will decide when this. The long term
Hmm.
undertone for India is positive. But in terms of the markets, there will be volatility for me at least till a pre Diwali stage. I
Oh,
think that
wow.
Diwali may be the outbreak we see because you see, look at it. No, the third wave, India's vaccines severely short. So many states have stopped the 18 to 45 vaccination. So you got to build herd immunity. You'll need at least 70-75% of the working population to be vaccinated or have had COVID. So I think it is a few months away. So let's be honest and be realistic about that.
You were just talking about the government's approach in COVID 1.0 and 2.0. Similar move has happened with the markets also because because in 1.0 there was so much panic and there was so much of selling that we saw, which clearly isn't happening this time around, despite the fact that there is a massive consumption slowdown. We are staring at a lot of manufacturing companies and the industry taking a beating because of intermittent lockdowns across different states. Why is it that the market has not sort of reacted as sharply this time around? Have they completely factored in all of the COVID impact?
No, not necessarily that they're factored in, but it's once bitten, twice shy. So last time
Okay.
when the first wave struck, everybody panicked. And what happened? Those who pulled out money and put it into bank deposits or into liquid assets, right, debt funds, found that there was a doubling of the Sensex and a far greater growth in the mid and small cap. And they missed that journey. So, market participants are as much emotional as rational decision makers. So they said, oh, last time. Then what happened was, why did the markets rise? Because the response of central banks and the economists, governments, that is fiscal side and monetary side, was to throw more money at the problem. So what the market participants are realizing is that even if the news is bad, you shouldn't stay completely out, because when more money is
Hmm.
thrown, ultimately before the economy recovers, it's the markets which absorb that liquidity. So what happens is that the worse the news gets on the COVID front, the worse it gets on the economic front, the more the foreign central bankers are likely to keep the liquidity tap open. So then I know that stocks are going to crash. So it doesn't make sense for me to time out and time in later. Might as well stay invested. I think it's just a learning curve for the market participants.
What about the trend, that we've been witnessing, FII versus DII? Because after massive selling in the month of April, FIIs still continue to sell in the Indian markets, while DIIs, however low the figure may be so far for the month of May, are net buyers. Is that a trend which is likely to stay for another
I
few
think so.
months?
I think so, because, like I said, foreigners are still waiting to assess the medical impact of this on the country and then what permanent impact it will have on the economy. That's one. Second is there's a metals rally which is happening, there's a commodities rally which is happening. So, last year, commodity exporting countries like Brazil, Russia didn't get any FII flows. India got away with 70-80% of the total FII flows because we were commodity
Right.
importers. Because of that, our costs were coming down, and this. Now, foreigners realize that as commodity prices rises, those markets are beginning to look more attractive valued. So there will be a readjustment of flows, and India can't expect to get the same 80% of flows. It will probably taper down to say 60% of the overall emerging market flows. So you can expect that FII flows will be volatile, and DIIs, because what are they seeing? They are seeing that ultimately this time the government is not hitting the economy with a super lockdown, is allowing the states to manage it. So they don't expect the economic impact to
Hmm.
be severe, and hence they feel that good quality stocks which FIs are selling is a good time to buy them from a 3 to 5 year perspective. So I think this balance is likely to continue for the rest of this year, at least till Diwali.
Okay, so Diwali is when I think we should be closely watching out for key trends to really play out, and hopefully the COVID impact to wean off.
Correct.
Um, you just were talking about commodities rally, and that just brings me to my next question. How can we not talk about the rally that we've seen, especially in metals? Um, Talk to us about what is your assessment of the way they have moved up. Of course, barring today when we saw a tad bit of profit booking in the metal space, but overall the trend has been very, very strong. Are there more legs to this rally? Are there more triggers for participants to buy into metals?
So we believe that in the near term, metals are probably near their peak. Because if you
Okay.
find out the reason for the rally is more the China recovery. China got COVID first, controlled COVID first, came bounced back first. So China, being a heavy engineering oriented country, need for metals and everything that goes into industrials, infrastructure related, anything shot up. So there was a rise. That's number one. Number two is the fact that now the credit gap has narrowed, which means the demand supply gap for credit is very narrow. Now the regulators in China are getting worried about the fact that credit can fuel inflation. So they're trying to cool down that. So we don't expect incremental demand from China or expected demand from China to play into the story. So we believe that a lot of the Indian metal stocks are reacting to this for two reasons. One is that metals are priced off the LME. So the London Metal
Hmm.
Exchange prices translate to Indian companies. So regardless of whether the demand supply situation in India is in favoring demand, the prices have started going up. So this is just an imported kind of an inflation into metal prices, right? So what will be the next trigger? While next few months I expect the metals rally to cool off and to kind of stay at these levels, there are two big triggers which could give a further uptick to the metal rally, which you should watch for. The first trigger is domestic. It is about controlling COVID and the fact of the matter that the government's budgetary focus on infrastructure plus the opening up of the PLI scheme to a lot more sectors so that FDI can come in. And so when new plants get created, steel gets into demand because it's a part of concrete, it's a part of machinery, everything. So if you see a quick end to the third wave and control, you'll expect that economic infrastructure-led growth to come back on track when metals will get a support from the domestic demand perspective. And the third and the real big number is the $2 trillion infrastructure spend that Biden has promised, which has to pass both houses of parliament. We are not yet sure that they have bipartisan support for that. But if that happens, that will trigger a massive rally because if US spends 2 trillion on infrastructure, you can imagine what's going to happen to the steel demand and all of that to implement that project. So these two big factors are waiting to happen. Until then, I expect that metals, the big rally has happened. It will probably be stable at around the current levels. But next uptick in metals, you have to wait for those two triggers that I mentioned.
How can retail participants prepare or sort of go stock picking at this point in time? Of course, you are saying that you expect a good up move or a good market action happen closer to Diwali, and the upcoming few months will be slightly dull. But at this point, is it a good idea to go stock hunting and look for value buys, perhaps, from a retail standpoint?
So I would say 3 points to keep in mind for retail buyers, right? First is follow the leaders, right? So the leaders are going to be domestic mutual funds and insurance companies, right? So follow their path in terms of what they're going to buy. What are they going to buy? They're going to buy the domestic growth story, right? So when you say domestic growth story, you're then talking about industrials, cement, building material, so those kind of a stuff. So I would say that if you follow those patterns, you'll be able to catch the early birds in terms of getting your uptick done. So if you follow what domestic MFs are buying, right, I think that will give you a good clue, and which is domestic oriented. That's number one. Second aspect is the fact is that domestics, when they buy, they don't focus only on one particular market cap segment. So if they like industrials, they'll buy some large, some mid, some small to spread out the portfolio and to get a diversification into the play. So you will see that this rally will be broad based. So don't restrict to one cap curve, broad based your thing. So that's the second point. The third aspect here, since I mentioned that I expect volatility till Diwali, the best way to
Hmm.
approach is to systematically allocate across this next 6 months. So do a 6 month STP, put the money in your liquid fund and put it into the broader equity space, systematically over the next 6 months so that you will get sometimes market correction will come to your benefit. I think if you take these three broad approaches for a retail person, right? First is follow the domestic, big buyers, what they are buying. Second is to keep broad based versus focused narrow. And third is to allocate systematically. These three follow the rules. If they follow, I'm sure they will benefit over the next medium term, 3 to 5 year time period.
Okay. But like you said, go local is ideally so that's a one should look at, and domestic companies with good exposure within the country. But we've talked commodities. I would also like to address at this point the kind of frenzy we've seen in sugar stocks as well. But any other theme or any other sector within the broader market or with the broader theme of domestic industry that you would like to perhaps nudge our viewers towards?
So I would say that to me, cement and steel are two core parts of the domestic portfolio, right? But I would say overlay it with the banks. The reason I bring banks into the picture is no economic growth can happen without bank lending. And today banks are in a sweet spot because they've got huge liquidity stuffed into their mouths by RBI. They've got huge savings on interest costs because there's been whatever, below 3% average cost in terms of the repo, their CASA balances. So they're sitting on potloads of money. And I think by and large, the COVID fear about NPAs is, I think, behind us because they've all upped their provisions in this period to more than cover for an expected NPA bump up. So I think they're in a very good wicket. And so the economic story has to be financed by banks. So I would say banks should be a core part of your portfolio, and I believe that's what will ultimately benefit wherever the things happen. So the apart from these two, you mentioned domestic, but I still think that one shouldn't lose sight of international. So two ways to participate in international also in this period, because the world is also going to recover from COVID, would be one is IT. I think IT is also in a good play. The only thing is IT valuations are fairly rich. So it's a stable part of your portfolio. There will be growth, but it's an expected growth. The surprises may not be so many, but it's important to stay in IT because it's going to be a good story and it gives stability to your portfolio. And fourth, I would say look at diversified global funds, because India is not going to be the only growth story, and I think there are, as the whole world recovers from COVID, there'll be lots of pockets. So if you go for a globally diversified mutual fund and make an allocation to international funds, I think it's a good time to do that. Don't go behind chasing the US, because the US has seen a dream run over the last few years. So I would say for a diversified portfolio internationally, it's also be useful for retail investors to add these two components, IT and global diversity, to their portfolios.
Well, that's a lot of options. Food for thought you've given our viewers for the weekend. I just want to talk a bit big picture and a bit macro right now. Uh, as we all know it, COVID has, impacted and severely hit traditional linkages. There's labor shortage, there's demand which is outpacing supply, you have unemployment which is looming quite large. So, in the backdrop of all of this, the inflation debate has really heated up. So, if you could tell us what is your view, do you see any sharp jump in inflation going forward, whether it's US or having any kind of impact even on the Indian markets? Any concerns on the inflation front?
So there are three aspects to inflation, right? There's a demand side inflation and a supply side inflation, right? And when I said three, supply is split into domestic supply and imported inflation from goods that we import, like say oil and other commodities, right? So if you look at the whole picture around inflation, I think that the three components, I don't think demand side inflation is going to come and hurt, right? Because of the COVID, the impact, demand is going to be slow. People are going to take time to come back. Industries will take time to come back. So there's going to be no pressure on inflation from a demand perspective at all. Again, for me, Diwali is the next trigger of any kind of consumption demand pulling it up. Now, we come to the supply side, right? Let me address the domestic side first. So, domestically, if you see, right, food is a key part of domestic inflation, and you've had a good monsoon forecast. You've had plentiful supply of food grains. India is, in fact, exporting some food grains out. So, I think there is enough
Yeah.
supply. So, domestic supply side, I don't think food being the bigger basket is going to impact, right? So, food, vegetables, all of that should be soft. The imported inflation is the concern because oil right now is kept under balance between OPEC, Russia, and US as a balancing play. They have kept supply fairly constant and keeping oil prices constant. However, if there's a recovery in the advanced countries, which is more than expected, you would expect energy demand to go up and you would expect oil prices to go up. So that's a risk for Indian thing. One.
Hmm.
Second is this metals rally means that all consumers of metal, auto industry, right, electronics industry, right, all of them, and you have seen this shortage of digital kind of semiconductors and all of that. That imported inflation will affect earnings of companies here, right? So from a stock market perspective, imported inflation is key. need to watch out for. But from an economic perspective and what the RBI thinks perspective, I don't think that inflation is a worry, that RBI is going to switch to inflation fighting versus growth supporting. I think RBI will continue to be accommodative and growth supportive, especially with the second and third waves. So from that perspective, the markets will welcome a soft stance from RBI, whereas individual companies and sectors which are impacted are definitely going to see their earnings will not come up to the expectations, but analysts are quick to revise those. So you will see that there will be a revision downwards of all the input cost heavy kind of companies in the coming quarter.
All right. While, I agree that one would only witness some significant action in the markets in the next few months, but any important data points, lead indicators that our viewers should be looking at for over the next few months, any
Yeah,
reports,
I
etc.,
think
which
that
will be releasing?
yes, I think two, one international and one domestic. Internationally, it's got to be Fed speak, right? Based on the US data. Indian users can't understand all the nuances of US data. But what that sums up in terms of Fed policy, the way they speak, and what do they say? Because this fear of tapering is haunting the markets. The moment anybody says something, there will be an earthquake-like impact on the market. So people should very carefully track the Fed policy minutes. What do they talk? Which will give them a clue for the future, whether liquidity supply from the US is going to remain or not, and our interest rates going to head up there. So that's one from the international. Domestically, I would say it's the it's the wave control, the vaccination. That's the progress. I think whether it's a foreign investor or anybody domestic investor, I think everybody is worried about this COVID thing. So at this point of time, while you can take a perverse pleasure that if the COVID thing strengthens, RBI is likely to continue their accommodative stance. It's a very perverse way
Yeah.
of looking at it, but frankly, that's the support for the markets. So, market, even if some bad COVID news comes, market may not react so badly because RBI will come out and say some more liquidity, some more, soft policy. So that's a balance
RBI
that
to
you
the
got to track.
rescue.
RBI to the rescue.
Right. Thank you so
Okay.
much, Mr. Subramaniam, then
Okay.
for enlightening our viewers for what to look at over the short term and over the next few months as well. Always great having you on board. Thank you once again.
Thank you. All the best to your viewers. Thank you.